Hello, welcome to Chapter 8. We're going to continue talking about budgeting. In Chapter 7, we talked about putting together a master budget. Chapter 8 talks about how to evaluate our performance against that budget. So here we're going to talk about flexible and static budgets. A static budget is another way to refer to our master budget. So a master budget can be referred to as a static or standard budget, and it's based solely on expectations, what you think is going to happen. On the other hand, a flexible budget can be based on preparing a budget based on the actual level of activity using our assumptions, okay? So flexible budgeting is more helpful in management's decision process. So here we're looking at a company that provides us with some information about its proposed sales for the year. The company plans to sell 18,000 trophies. Here we have our detailed information about selling price, standard cost of materials, labor, and overhead. These are referred to as the standard costs. Okay, these are our assumptions that we used when putting together the master budget. With the help of our spreadsheets, we can actually prepare flexible budgets for both planned and actual levels of activity. The flexible budget is a way for managers to determine whether people are effectively controlling revenues and expenses. So the master budget tells us what should happen based on a level of activity. The flexible budget takes what actually happened and applies our assumptions to see what it should have cost us so it compared to what it actually did cost us. So you can see here, our static budget is based on 18,000 units. The flexible budget prepares what we think should happen if we sell 16, 17, 18, 19, or 20,000 units. In order to understand how we're doing, we need to be able to determine if a variance is favorable or unfavorable. In accounting, the difference between a standard amount and an actual amount is called a variance. The variance can be favorable or unfavorable. You can have favorable sales variance because you had higher sales, which increased your net income. However, when sales are less than expected, it's unfavorable. The opposite kind of holds true for when you're looking at expenses. When actual costs are less than standard costs, that means it's favorable because lower costs increases net income. Unfavorable cost variances exist when actual costs are higher than standard costs. So you really need to think about what you're looking at and what's better off for the company. So the difference between the static budget sales amount and the flexible budget sales amount is a measure of the sales volume variance, okay? So here we have an example where we thought we were going to sell 18,000, but we actually sold 19,000 trophies. In order to understand whether or not we have favorable or unfavorable variances, we need to look at what actually happened. So we're always going to have a favorable volume variance because we sold more units than we planned. And then our expenses are going to be unfavorable because logically you have to spend more if you sell more, okay? So looking at our flexible budget versus our static budget doesn't really help us. What we need to do instead is prepare a flexible budget and compare it to our actual versus our master budget. In order to put together our flexible budget, we need to start off with our standards, okay? And we're going to be comparing our standards that we use to put together our master budget versus what actually happened. So we're going to take our actual results and we're going to basically what we're going to do is come up with a flexible budget based on 19,000. So 19,000 units times our standard material cost of $12, 19,000 units times our variable labor cost standard of $16.80, and so on. Comes up with these numbers. Now we can really compare what actually happened when you sold 19,000 units versus what we thought should happen when we sold 19,000 units. And then you can see that we actually made less money than we thought because our sales price per unit was less than what we thought it would be. And then you can go through the costs as well. So these standards represent the amount a price, cost, or quantity should be. We develop these standards in order to understand what we think should happen versus what's actually happening. So how do we develop these standards? Well, ideal standards could only be obtained under the best circumstances. They allow for no work interruptions and require employees to continually work at 100% efficiency. This isn't really practical. Practical standards are tight but attainable. They allow for normal machine downtime and employee rest periods and can be attained through reasonable, highly efficient efforts of the average worker. These are the standards that you want to put in place. Okay. So why do we need this? Well, it helps managers benchmark actual performance. Management by exception is the process of focusing on material differences between actual and expected results. You're not going to look at every single difference, only the ones that are material or important. A good manager is going to consider 4 variables when investigating variances: the nature of the variance, how frequently it occurs, how likely it is that we can control it, and the characteristics behind the variance. We want to know what the root cause is. So I'm going to end it here, and I'm going to post another video that walks through how to calculate our different materials, price and usage variances, and labor price and usage variances. So there's 2 things that drive a variance. So if we go back to our flexible variance, involved in materials is how much of a material you're using and how much that material costs you. Same thing with labor. So that $4,180 variance is actually made up of 2 things. You either spent more or less than you thought you would on the material, or you used more or less than the material than you thought you would. So the next video is going to walk through how to calculate those variances.